My name is Satoshi Kono, Executive Vice President of Raccoon Holdings, Inc. Thank you for gathering here today to attend the financial results presentation for the second quarter of the fiscal year ending April 2025. The summary of financial results was released earlier today at 15:30, so allow me to use this opportunity to dig a little deeper into the results and offer more information. As we usually do in these financial results presentations, we have identified a number of key points. More specifically, we have identified 5 key points, the first being the fact that first half results landed at a level that exceeded the plan, both in terms of sales and profits. Additionally, as we have gone over on previous occasions, we are aiming for a V-shaped recovery and expect to record the highest profit in company history over the course of the fiscal year ending April 2025. I will be going over the specifics in a moment, but for now, allow me to simply state that as of the end of the first half, we had made very good progress toward this target. Point number 2 pertains to the EC business, within which we operate our super delivery website. During the period under review, Raccoon continued seeing a very strong performance in super delivery GMV, gross merchandise value. In terms of the specifics, beginning in the second quarter of the April 2024 fiscal year, we have executed a number of initiatives in the super delivery business. For example, we started offering a free-of-charge plan and enhanced our sales promotion initiatives. GMV is the product of the number of clients and the value of transactions per customer, and, starting in the second quarter of fiscal year 2024, we have focused our efforts on growing the number of buying customers. These efforts have borne fruit, with the number of buying customers showing particularly significant growth in the second quarter, and we saw pronounced growth in repeat purchasers. On the other hand, we feel there is some room for improvement in terms of the value of transactions per customer. We had seen a decrease in the value of transactions per customer over time, in part brought down as a result of an increase in the number of new customers. Intense late summer heat in the second quarter made it difficult to move fall-winter clothing inventory, and translated into a continuation of this trend toward lower values in terms of transactions per customer. As you'll remember, back in late August, I mentioned how we expected the first quarter to mark the bottom in terms of the value of transactions per customer, but unfortunately, this downward trend continued in the second quarter. That said, we recorded a very robust increase in the number of buying customers, so we were ultimately able to record robust GMV growth. More specifically, domestic GMV was approximately 9.5 billion yen, up 9.4% on a YOY basis, while international GMV was approximately 3.8 billion yen, up 15.9%. Overall GMV, too, delivered double-digit growth to reach approximately 13 billion yen, up 11.2% during the same period. Looking at the domestic and international breakdown, domestic EC saw a very significant increase in the number of repeat purchasers, which grew by 22.5% on a YOY basis. Circling back to what I said earlier, starting in the second quarter of last year, we started offering a free-of-charge plan and enhanced our sales promotion initiatives, and these efforts have significantly catalyzed growth in the number of members. We are therefore looking at a rather steep YOY comparison, with the aforementioned efforts translating into targets that are harder to beat. In spite of this, the number of repeat purchasers nevertheless increased by 22.5%, so we view this as being rather significant. Internationally as well, we saw very strong growth in the number of buying customers, and this increase has been driving GMV growth. One notable difference is that, unlike in Japan, the value of transactions per customer is not on a downward trend, but rather remains mostly flat. To be precise, it's down slightly, but for all intents and purposes, the value of transactions per customer remained flat YOY. As such, the increase in the number of buying customers has translated into GMV growth in the overseas segment. Of the 4 main countries we operate in, that is Taiwan, Hong Kong, the US, and South Korea, Only Hong Kong struggled, while the rest posted very strong growth. We will be going over the details for each country in a moment. Point number 3 pertains to the financial business, which continues to deliver very strong growth. Allow me to start with the results for paid, which delivered double-digit, 13% to be precise, YOY growth in the first half in terms of the transaction value. Similarly, Uriho's guarantee balance at the end of the period had increased by 14.5% YOY. Paid, in particular, saw a very significant increase in the number of member companies, and, what's more, we're also seeing a gradual rise in occupancy rates. In light of this, Paid was able to post a record high transaction volume in the second quarter and exceed the 10 billion yen mark for the first time ever in company history. An important indicator in the financial business is the cost of sales, which corresponds to the rate and cost of defaults. The rate of defaults in the second quarter came in lower than expected, with a cost of sales of 23.6%, down 1.8 percentage points YOY, and 2.2 points QOQ. Naturally, gross profit margins are the inverse of this cost of sales margin, meaning we have seen an increase in gross profit margins, and this has had the effect of boosting profits over the short term. We will be looking at a graph in a moment. Last, we have Raccoon Rent, which is our old rent guarantee business. As previously announced, we carried out the sale of Raccoon Rent to Entrust Inc., which is a publicly traded company, and this deal was completed immediately after the end of the second quarter, on November 1st, 2024. The vertical bar graph shows a rough projection for the financial business. Naturally, we will no longer record sales previously associated with the rent guarantee business in the third quarter and beyond, so we expect this to translate into a lower net sales growth percentage. In other words, we expect negative net sales growth in the financial business in the third and fourth quarters. That said, this is the result of the sale of the rent guarantee business and is therefore entirely expected. For a more accurate measure of net sales growth, we will be taking Paid and Uriho's growth rates separately, so we would like to assure stakeholders that this decrease in net sales growth percentage is entirely normal and expected. Point number 4 pertains to the topic of future gross margin improvement. Note that this isn't a project we expect to achieve over the course of the ongoing fiscal year, but rather over a timeline extending into the future. Very high profit margins are one of the defining characteristics of our business. In the second half of the ongoing fiscal year and beyond, starting this month of November, we expect the EC and financial businesses to see further gross margin percentage improvements. The factors that led to this improvement in gross margin percentage in the EC business are straightforward. We were able to negotiate lower fee rates for credit card payments, and these lower rates translated into an increase of 2% in gross margin starting in November. Gross margin for the EC business stood at 77.4%, and we expect to be able to add a further 2 percentage points on top of that, meaning a greater probability we will see profits go up. Regarding the financial business, we completed the sale of our rent guarantee business on November 1st, 2024, meaning that this business will be excluded from the scope of consolidation. Compared to Paid and Uriho, gross margins were relatively low in the rent guarantee business, so we expect an increase in gross margin of approximately 3 percentage points. Looking at the data for recent months, gross margin in the financial business stood at 75.3%, and we now expect to be able to add a further 3 percentage points on top of that. We put particular emphasis on gross margin percentages, and this expected growth in gross margin, by 2 points in the EC business and 3 points in the financial business, will translate into a greater contribution per net sales unit added, and this is something we view in a positive light. Point number 5 pertains to the topic of share repurchases. As announced on October 21st, 2024, the company will be carrying out a share repurchase operation. Within the scope of this operation, we will be repurchasing up to 1.1 million shares, corresponding to approximately 5.1% of the total number of issued shares, at a total repurchase cost of up to 1.1 billion yen. Lastly, the repurchase period will continue through the end of the ongoing fiscal year. To reiterate, Raccoon Holdings will be repurchasing up to 1.1 million shares through to April 30th, 2025, for an amount of up to 1.1 billion yen. The purpose of this operation is to enhance shareholder returns and improve capital efficiency. Also on the topic of shareholder returns, and as outlined in the summary of financial results released today, November 29, 2024, we expect to distribute an annual dividend of 20 yen per share, consisting of two payments, in the first and second halves, respectively, corresponding to 10 yen per share each. An end of second quarter dividend of 10 yen per share, coupled with a year-end dividend of 10 yen per share, for a total of 20 yen per share, is in line with the previous record for the company. This concludes my overview of the 5 key points for the second quarter. I would now like to go over these topics in greater detail. Next is a summary of the consolidated results, the statement of income, covering the results for the first half of the fiscal year ending April 2025, and the rate of progress made versus the first half and full year forecasts. In the first half, we registered 3.052 billion yen in net sales, up 8.3% YOY, corresponding to a rate of progress of 101.8% versus the first half target. Net sales therefore came in slightly above target in the first half. We registered 619 million yen in operating income, up 89.9% YOY, corresponding to a rate of progress of 106.9% versus the first half target. Ordinary income stood at around similar levels, while net income came in at 289 million yen, up 42.7%, corresponding to a rate of progress of 115.6% versus the first half target. In light of these results, we believe Raccoon posted a rather strong earnings performance. In terms of the progress versus the full year forecast, as shown here in the rightmost column, net sales results came in at exactly 50%. As you may be aware, Raccoon's net sales performance tends to be more heavily weighted toward the second half, so a rate of progress of 50% by the end of the first half is actually quite positive. The line items of operating and ordinary income came in slightly below the 50% mark, but results for these also tend to be more heavily weighted toward the second half, so we view realized first half performance to be in line with the full year forecasts. Only net income, therefore, came in somewhat below the forecast, but there's a valid reason for this. More specifically, the sale to Entrust Inc. of the rent guarantee business was completed on November 1st, 2024, but before that, in October, we transferred a portion of the contractual status for the rent guarantee business to another third party. This transfer led us to record 123 million yen in extraordinary losses in the second quarter, meaning this one-off loss is the reason net income came in slightly below the full year target. Next are the consolidated results excluding advertising and sales promotion expenses. As I believe you are aware, last fiscal year, we made the decision to incur some short-term pain in the form of an increased resource allocation to promotion efforts, etc., in order to catalyze growth going forward. We therefore aired a number of TV commercials and offered comprehensive loyalty point program campaigns, and these efforts led to a ballooning of advertising costs. As you can see from the table, we had recorded 632 million yen in advertising and sales promotion expenses in the first half of the fiscal year ended April 2024. This amount shrunk to 485 million yen for the corresponding period in the fiscal year ending April 2025, on account of the fact that we discontinued mass media advertising like TV commercials. We also didn't carry out comprehensive loyalty point program campaigns, as there wasn't a need to. On the other hand, listing ads and social media ads and other basic strategies to drive customer traffic remain at levels comparable to last fiscal year, which correspond to a higher baseline. Advertising and sales promotion expenses are therefore down on a YOY basis, and this, along with other factors, contributed to an increase in operating income excluding advertising and sales promotion expenses from 959 million yen to 1.105 billion yen, which represents a double-digit increase of 15.2%. Next are the trends in group GMV and in the Uriho guarantee balance. In the 3-month period corresponding to the second quarter, group GMV stood at around 17 billion yen, corresponding to the transaction value within our paid and super delivery services. As you can see from the graph, this represents a very robust growth trend. On the other hand, the pace of growth in Uriho's guarantee balance, shown here on the right, saw a bit of a slowdown in the second quarter. I will be going over the details in a moment, but to summarize, we posted a very strong group GMV from super delivery and paid, while Uriho has shown a bit of a slowdown in the second quarter. Next are the trends in consolidated net sales. Here, the results are in line with what I have discussed earlier, with very strong YOY growth for both the EC and financial businesses from a second quarter of fiscal year 2024 baseline. Next are the trends in net sales by quarter. Here too, we have been seeing strong results, but it is worth noting a slight QoQ net sales decrease in the EC business between the first and second quarters. More specifically, while we had recorded 865 million yen in net sales in the first quarter, this figure dropped slightly to 858 million yen in the second quarter. This represents a QoQ decrease of approximately 7 million yen. Generally speaking, there is an element of seasonality to our operations, with sales tilting toward the second half of the fiscal year. Furthermore, within the first half, second quarter results tend to slightly exceed first quarter results. That said, factors like the late summer heat we saw this year can flip this dynamic because warmer weather makes it hard to move fall-winter inventory, and this translated into a slight decrease in GMV in the second quarter, compared to a first quarter baseline. Weather effects have impacted sales before, more specifically in April of 2013 and 2017, but these impacts, including the one this year, are ultimately of a one-off nature and have historically been followed by a strong recovery. In summary, this slight net sales weakness in the EC business was therefore the result of one-off weather factors. Next are the trends in gross profit for the EC and financial businesses. Sales were down in the EC business, so this naturally translated into a decrease in gross profit. Conversely, gross profit was up rather significantly in the financial business, rising from 546 million yen in the first quarter to 571 million yen in the second quarter. This increase was naturally in part the result of higher sales, but another factor was a lower cost of sales. In other words, gross profit margin itself is up, meaning a rather significant growth in gross profit. Next are the trends in expense composition. More specifically, this refers to advertising and sales promotion expenses, personnel expenses, and other expenses over the first 6 months of the ongoing fiscal year. As you can see from the vertical bar graphs, while we had seen a sharp increase in advertising and sales promotion expenses in the equivalent period in the fiscal year ended April 2024, these were down during the 6 months of the ongoing fiscal year, as we discontinued the use of TV commercials and comprehensive loyalty point program campaigns. As was the case last fiscal year, and in line with general cross-industry trends, we are seeing a slight upward trend in personnel expenses. Next are the trends in operating income for the first half. As you can see from the vertical bar graph on the left, we are aiming for a V-shaped recovery and a new record high for the metric of operating income in the fiscal year ending April 2025. As it stands, we have been making good progress toward this target. Last year, we made the decision to incur some short-term pain, allowing us to reap the benefits later on, so naturally this led to low profit levels, but we have now been able to slightly surpass the results for the second quarter of the fiscal year ended April 2023. I will be going over the details in my overview of the EC business, briefly speaking. Last year, we raised advertising spending and sales promotion expenses in this business, and this has translated into an increase in SG&A expenses. We have now, in the second quarter, reached GMV levels corresponding to a break-even point, offsetting this higher SG&A baseline, and this allowed us to achieve a recovery in operating income back to a level slightly exceeding fiscal year ended April 2023 results. GMV has now exceeded the break-even point, offsetting this higher baseline, meaning the marginal profit contribution percentage is now very high, so we expect a further increase in GMV going forward to make a strong results contribution. Then we have the vertical bar graph on the right, which shows operating income excluding advertising and sales promotion expenses. In other words, this graph shows operating income excluding the aforementioned increase in SG&A expenses, with the exception of personnel costs, which were up, as I mentioned earlier. As you can see, operating income reached a new record high in the second quarter. This trend remains more or less intact on a bi-quarter basis. As you can see, we incurred significant costs last fiscal year, but have now been able to stage a return to fiscal year 2023 levels, and expect to be able to further grow profits going forward. Next is a summary by segment for the EC and financial businesses, respectively. Circling back to what I said earlier, in the EC business, the increase in the number of buying customers drove GMV growth, both domestically and internationally. Allow me to direct your attention to a new measure within the domestic business in Japan, shown here as the second bullet point from the top, which reads, "Extend the payment due date for paid usage from 60 days to 90 days. Retailers have access to both paid and free of charge plans, and we now offer paid members who request this feature the option to extend their payment due date from a maximum of 60 days to a maximum of 90 days. The goal behind this initiative is to improve cash flows of members, with the objective of increasing average sales per customer. In recent years, we have been somewhat prioritizing the number of buying customers over the value of transactions per customer. That said, it's not like we disregard this, so we will be carrying out whatever efforts we can in order to boost the value of transactions per customer, and this is one such measure. We carried out a trial run before rolling out this extension of the payment due date in order to determine changes in customer behavior, and observed improved cash flows leading to an increase in average sales per customer. We will therefore be offering this option to this category of customers, as we have high hopes for this measure, which has done well in our trial run. Here is a detailed overview of the data for the domestic EC business. The figures here are in line with the topics and measures I mentioned just now. In brief terms, the number of buying customers has maintained a very strong pace of growth, growing by about 17% for retailers and by about 18% for the category of other than retailers. Conversely, this influx of new customers, changes in the customer mix, and other factors like the late summer heat we saw this year all came together to drive down the metric of sales per customer by an average of 8.7%. As such, while we continue seeing very strong growth in the number of buying customers, this increase was partially offset by a decline in average sales per customer. Once the ongoing decline in average sales per customer comes to a halt, we believe that this will translate into a very significant increase in GMV growth. We are therefore closely monitoring the metric of average sales per customer while executing initiatives to boost the number of buying customers. Next is the international EC business. Here we show the results in the 4 main countries we operate in. During our results presentation for the first quarter, I mentioned how Taiwan has now returned to positive GMV growth, and how we view this as an important and positive development in light of this country's high GMV composition ratio. We continued seeing GMV growth in the second quarter as well for this market. Conversely, I mentioned how we expect negative GMV growth for Hong Kong to continue for the foreseeable future, and this prediction regrettably came to pass in the second quarter. GMV grew by around 13% in the US and around 48% in South Korea, underscoring strong growth in these 2 markets. That said, we have seen a slight slowdown in terms of the GMV growth rate in the US compared to the results through the end of the first quarter. We are currently in the process of determining the reason behind this decline, but it would appear, contrary to our initial hunch, that foreign exchange effects in the form of a strong yen have negatively impacted GMV. Another factor is peripheral costs customers incur when they buy products, things like shipping costs and handling fees. We have experimented with raising and lowering these and have observed a sharp decline in GMV growth after raising costs and fees, and these tests ended up weighing down on GMV growth somewhat in the second quarter. That said, the US is a very large market, so we don't expect GMV growth levels to stagnate, but rather recover going forward. Additionally, we have released tie-up videos with influencers and YouTubers in the US and South Korea, and these efforts have been very successful. We have now expanded these efforts to other English-speaking countries, namely Great Britain, and we are seeing good results. Lastly, outside the 4 main countries, Australia and Thailand performed well, and we would like to see these countries continue to grow in terms of their GMV composition ratio. The trends in super delivery gross merchandise value are as shown here, and in line with what I mentioned earlier. GMV was therefore down slightly in the second quarter on a QoQ basis. Next is the quarterly trend in the number of buying customers and the value of transactions per customer. As I mentioned earlier, while the number of buying customers is up, the value of transactions per customer is down slightly. Page 27 shows a breakdown of the number of buying customers. The number of repeat purchasers continues to exhibit strong growth, and this is something we view in a promising light going forward. The value of transactions per customer in the international segment was down slightly on a QoQ basis between the first and second quarters, but the general trend is more or less flat and actually up from realized results in 2022 and 2023. On the other hand, domestic retailers continue facing headwinds, with this downward trend extending into the second quarter, in part as a result of the late summer heat we saw this year. The vertical bar graph on page 29 shows the trends in sales, which we have already discussed at length. Noteworthy here is how the take rate continued to rise moderately to 11.18%, up 0.11 percentage points on a YoY basis, and 0.45 points versus fiscal year 2023 levels. Next are the trends in segment profit for the EC business. As you can see, segment profit has at last recovered to fiscal year 2023 break-even point levels. Next is the summary for the financial business. Transaction volume for paid increased by 13% YoY, exceeding the 10 billion yen mark on a quarterly basis for the first time, and 20 billion yen in the first half. We are guiding for a full-year YoY increase of 14.3%, so realized results in the first half came in slightly below target. That said, we believe there is still plenty of room for us to catch up and meet the full-year target. In summary, Paid has posted strong results thus far, and we have a very positive outlook on this business. Regarding Uriho, as I mentioned earlier, not everything has been smooth sailing for this business. We are guiding for a full-year YoY increase of 24.7% in Uriho's guarantee balance, but since realized results in the first half only came to 14.5%, this means we are behind schedule. One factor for this has been a decrease in promotion spending in the financial business starting last year. Consequently, while we believe that raising promotion spending once again would translate into a recovery, we don't believe this to be the right course of action right now. We will of course allocate an adequate promotion spend, but we would rather focus on raising occupancy rates and keeping membership attrition under control, although admittedly, attrition already isn't all that high to begin with. The idea is the thorough execution of these efforts, which are yet to bear fruit. As such, unfortunately, we don't really expect a sharp recovery in the Uriho business to materialize over the course of the ongoing fiscal year. That said, we will be executing a number of measures in the second half, which we expect will start bearing fruit next fiscal year and beyond. The trends in paid transaction value are as shown here in the graph. Starting around the fourth quarter of last year, we saw a jump in the transaction value prompted by growth in external transactions. We therefore have a very positive outlook on this front going forward. The trends in Uriho's guarantee balance are as shown here in the graph. We have seen a slight decrease when it comes to growth in our subscription-based guarantee balance. While this does give us some cause for concern, Raccoon is working as a cohesive unit in the execution of efforts to raise occupancy rates and keep member attrition under control, so we request your patience on this front. Next are the trends in sales. As you can see from the graph, combined sales for Uriho, paid, and the rent guarantee business continue on a steady upward trend. However, as I went over earlier, in light of the sale of the rent guarantee business, starting in the third quarter, we will no longer record net sales associated with this business, giving the appearance of negative growth over the next number of quarters. That said, we naturally expect growth for Uriho and paid. Next are the trends in the rate of the cost of sales, which we position as a key metric. The cost of sales more or less corresponds to the rate of defaults. Within our portfolio, we positioned the band between 25% and 35% as the ideal rate of defaults, with realized second quarter results falling slightly outside and below this range, with the effect of boosting profits over the short term. Low default rates are partially the result of highly accurate credit checks on our part, and the fact we have been able to keep defaults low despite surging default rates in the overall market in Japan is really a testament to our expertise. There is also an accounting reason for this. More specifically, default rates have remained low over the past number of years, so after consulting with our accounting firm, in the second quarter, we were able to lower our provision percentages. This factor also contributed somewhat to this decrease in the rate of the cost of sales. That said, going forward, we don't believe we can necessarily promise a cost of sales rate around second quarter levels of 23%, so we ask you to bear this in mind. Lastly, we have the trends in segment profit for the financial business. We recorded a very strong segment profit performance of 192 million yen, up 53.1% YOY and 5% QOQ. We hadn't yet started allocating more resources to promotions in the second quarter of fiscal year 2024, so this YOY profit growth of 53% in the financial business really does correspond to a growth of 53%, so we view these results in a positive light. As I mentioned earlier, the EC business has now reached the break-even point, offsetting a higher SG&A baseline, but this dynamic is a little bit different in the financial business, since higher sales in this business translate very well into profit in light of gross margins above 70%. Additionally, promotions are also down slightly on a YOY basis, and this contributed to this growth. This concludes today's presentation.